This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the deep dive. Have you ever thought about the quiet guardians working behind the scenes, those unsung heroes who really underpin the integrity of the fund world right here in Luxembourg? Today, we're taking a deep dive into two absolutely critical players, the depositary and the transfer agent. Our mission is pretty clear. We're going to unpack their core functions, navigate the, frankly, seismic shifts from recent regulatory updates that are really reshaping their responsibilities. And we want to give you practical, actionable insights, how these relationships get set up, priced, managed. Think of this as your fast track to being really well informed, hopefully with some of those crucial aha moments you want to remember.
That's a good way to frame it. And these two roles, while they do different things day to day, they are deeply interconnected. They're like the essential backbone, really, forming this indispensable bulwark of security, of compliance for the whole fund industry here. They are, fundamental to Luxembourg's status as a top global fund center, directly ensuring investor protection, market stability. It's key.
The essential backbone. I like that. Okay, so as we start this deep dive, let's maybe flag three critical takeaways first. Things that are really redefining fund integrity in Luxembourg right now.
Absolutely. First, we're definitely in a new era for depositary liability. The CSSF, that's the Commission de Surveillance du Secteur Financier, the regulator made it incredibly clear back in July 2024. There's now this direct mandate for ex-ante controls on illiquid assets.
Ex-ante, meaning before the deal happens.
Yeah. Exactly. Pre-transaction, before anything's finalized. And look, this isn't just guidance on paper. That pretty significant administrative fine, 127,500 euros, levied just this past January 2025. That really hammered home the regulator's, zero-tolerance approach. It fundamentally shifts the operational model, the risk profile, for depositaries dealing with alternative investment funds. Big change.
Right. That's a major one. And second,
the transfer agent. It's really become a travel rule enforcer now.
And that's not just more paperwork, right?
Oh, much more than that. With the full application of the EU's regulation, EU 2023/1113, that's the recast transfer of funds regulation, fully effective since December 30th, 2024, and now brought into Luxembourg law via CSSF Circular 25/879 from early this year, 2025. Well, transfer agents are now legally required to ensure specific data.
About the sender and receiver.
Precisely. Originator and beneficiary data. It has to travel with all fund transfers. And that includes crypto assets now, too. It profoundly redefines their role in fighting financial crime. It's a huge operational lift.
Got it. And the third key takeaway.
Third, oversight. It's absolutely non-delegable. It remains central to the investment fund manager's duty. CSSF Circular 18/698 established this quite clearly. While you can outsource functions like transfer agency, the crucial oversight of that outsource function, that cannot be delegated. This was a heavy documented burden on the IFM, the investment fund manager, to do really rigorous initial and ongoing due diligence. And believe me, it's firmly under the regulatory microscope now.
Okay, so with those really critical shifts in mind, let's maybe take a step back, go back to basics. What exactly do these sentinels, as we called them, actually do day to day? Let's start with the depositary, the fund's ultimate guardian of assets.
Right. The depositary's role, it's this comprehensive tripartite mandate. It's an active supervisory function required directly by European law. The first pillar is safekeeping. Now, for financial instruments held in custody, think equities, bonds the depositary has to ensure they're held in segregated accounts, kept totally separate from the depositary's own assets. For other assets, things like real estate or private equity stakes, the duty shifts a bit. It becomes about meticulous ownership verification and really comprehensive record keeping, making absolutely sure the fund is the undisputed legal owner.
Okay, safekeeping. What's the second pillar?
Second is cash flow monitoring, making sure all cash movements are properly tracked, properly recorded. This includes verifying that all investor subscriptions have actually been received and that all the fund's cash is booked into the right accounts held in the name of the fund itself or the fund manager or the depositary acting for the fund.
And the third pillar, you mentioned it's often the most complex.
Yes, the third is oversight. This is the depositary's crucial watchdog function. It has a legal obligation, really, to ensure the fund operates fully in line with the law and its own constitutional documents, the prospectus, the articles. This covers overseeing the correct calculation of the net asset value, the NAV, verifying subscriptions and redemptions are handled correctly, making sure income is applied properly, and, critically, checking that the fund sticks to its stated investment policies and restrictions. Are they investing where they said they would?
And this whole framework, this tripartite mandate, it's applied differently depending on the type of fund, isn't it?
Precisely. For UCITES, that's undertakings for collective investment in transferable securities, the framework is very harmonized. It falls under Luxembourg's law of 17 December 2010. That law brings the European UCITES directive into Luxembourg law, and Article 33 is key here. It says a UCITES depositary must be a Luxembourg credit institution, essentially a bank.
A bank specifically. What?
It ensures the depositary has that robust capital adequacy, the regulatory standing, the whole infrastructure you'd expect from a bank dealing with retail accessible funds like UCITES.
Okay, that makes sense for UCITES. What about AIFs, alternative investment funds?
Right. For AIFs, the framework is governed by the law of 12 July 2013, often called the AIFM law. It implements the Alternative Investment Fund Managers Directive, or AIFMD. This regime is much more flexible. It's designed for professional investors for the diverse, often quite complex strategies you see in alternatives. So AIFs can appoint a credit institution, like UCITES, but also an investment firm, or, and this is a really unique and strategically important option for Luxembourg, a professional depositary of assets other than financial instruments. We usually call it a PDAOFI.
A PDAOFI, that sounds interesting. You said it's a unique selling point.
Absolutely fascinating, yes. The PDAOFI license, its creation was, well, frankly, an ingenious solution by the Luxembourg legislator. It directly tackles the challenges you get with illiquid assets, real estate, private equity, infrastructure. Traditional banks might lack the niche expertise, or maybe their fee structures just don't work for long-hold, low-transaction strategies. The PDAOFI license allows specialized service providers, often linked to fund administrators, to step into this critical gap. It deepens the specialization of the whole Luxembourg ecosystem. It really reinforces Luxembourg's reputation as a responsive, smart jurisdiction for alternative investments. It was a strategic masterstroke, really.
That really is a great example of innovation. Okay, let's pivot now to the transfer agent. Often the first point of contact for investors, as you said. How's their role evolved?
The transfer agent, or TA, sometimes called the registrar agent, they act as the architect, the gatekeeper of the fund's investor relationships. Their core duty: managing the fund's register of unit holders or shareholders. So this means meticulously processing all investor transactions.
Subscriptions, redemptions.
Exactly. Subscriptions coming into the fund, redemptions going out, any switches or transfers between funds or share classes. The TA also handles the related cash flows, communications like investor statements, dividend payments, but crucially in today's world, its most significant role, arguably, is as an AML-CFT gatekeeper.
AML-CFT, anti-money laundering and combating the financing of terrorism.
Precisely. The TA is right there on the front line. They're responsible for doing the Know Your Customer, the KYC, due diligence on every single investor. That means verifying identity, understanding the source of wealth, screening against international sanctions lists, robustly doing that, and diligently monitoring transactions for anything suspicious. And CSSF Circular 18/698 makes it crystal clear the ultimate responsibility for how the TA performs. That rests squarely with the fund's investment fund manager, the IFM. No delegation of that responsibility.
And that brings us to something you mentioned earlier, the Luxembourg model for transfer agents.
Yeah.
How is that different and what makes it stand out?
Yes, the Luxembourg model is predominantly based on registered shares.
Meaning the investor's name is directly on the register.
Exactly. The end investor is recorded directly by name in the fund's official register, which the TA maintains. This is quite different from nominee-based systems you see more commonly elsewhere, where shares are held by an intermediary, like a custodian bank or a platform. The Luxembourg model gives you greater transparency, and for the investor, there's a direct benefit. They typically avoid the custody fees that an intermediary would charge. This direct registered model has made Luxembourg particularly attractive, especially for these new digital fund distribution platforms that want to connect directly with end investors.
So the TA role has really changed then.
Oh, profoundly. A profound transformation. What used to be seen as a largely administrative back-office function has genuinely evolved into a critical, technology-driven risk management discipline. The absolute paramount importance of AML-CFT compliance, driven by wave after wave of EU directives and pretty forceful regulatory guidance from the CSSF, that has totally superseded the old focus on just processing transactions accurately. This constant regulatory pressure means TAs have had to invest heavily in RegTech technology, specifically for regulatory compliance. For automated screening, transaction monitoring, managing vast amounts of data, the transfer agent has really been elevated. It's gone from being a back-office processor to a truly strategic partner in the fund's whole compliance architecture.
Right. Okay, so we've got those core functions defined. Now let's dig into how the regulatory landscape is shifting under their feet. You mentioned the scrutiny on depositaries.
We are definitely seeing a new era of depositary scrutiny, particularly around illiquid assets. For years, there was this, let's say, ambiguity about the precise nature of a depositary's control duties for AIFs investing in illiquids. Was it ex post checks after the transaction or ex ante before? Different players did different things.
But that's changed now.
Decisively. In July 2024, the CSSF publicly clarified, for illiquid assets, checks and controls must happen prior to acquisition. Ex ante is the rule. This means a clear two-stage process. First, prior notification with draft documents before any payment goes out. This lets the depositary verify the deal makes sense, fits the mandate. Second, a follow-up verification after payment, using the final executed documents to confirm that, yes, the fund now effectively owns the asset.
And you mentioned enforcement followed quickly.
Very quickly. The market didn't have long to wait. Just this past January 10th, 2025, the CSSF hit a supervised entity with that six-figure administrative fine for breaches of depositary duties. And the failings cited directly echoed that July communication. So this rapid guidance to enforcement pipeline from the CSSF, it's undeniable. It forces a complete operational rethink for AIF depositaries. They now need the contractual rights and the operational capability to actually halt a transaction if an IFM doesn't provide enough ex-ante proof.
Which must add friction, right? And cost.
Absolutely. It inevitably introduces friction, increases costs, and ramps up the complexity of servicing illiquid funds. It raises big questions about how AIFMs will adapt their own processes.
A really significant shift indeed. Okay, so what about the transfer agent? You mentioned the travel rule impact.
Yes, a similarly profound transformation is hitting transfer agents, driven by that global fight against financial crime. Regulation EU 2023/1113, the recast transfer of funds regulation, basically extends the Financial Action Task Force's travel rule to crypto assets and tightens it significantly for traditional fund transfers too. That became fully applicable when? December 30th, 2024.
Right. And then the CSSF followed up.
Exactly. In early 2025, the CSSF cemented its application here in Luxembourg. They published Circular 25/879. This circular formally adopts the European Banking Authority's guidelines on the travel rule, making them legally binding here. So what does this mean in practice? For every single transfer of funds, the transfer agent, acting as a payment service provider in this context, must ensure that a specific prescribed set of information.
Names, account numbers.
Yes, names, account numbers, or wallet addresses for crypto. That data must travel with the transaction. And crucially, the threshold for this is effectively zero. It applies to all transfers, big or small. The rules demand that TAs detect if information is missing or incomplete, and they have to verify its accuracy before executing the transfer.
So it's not just checking boxes afterward.
No, it completely transforms the TA's AML-CFT function. It goes from being somewhat static onboarding checks to dynamic per-transaction compliance. Honestly, this is a task that just cannot be managed manually at scale. It absolutely necessitates automated interoperable systems RegTech again, and that investment need will likely drive further market consolidation among TAs. Smaller players might struggle.
Makes sense. Now, beyond these specific role changes, you also mentioned broader legislative updates, like the 2023 Toolbox Law. How does that fit in?
Indeed. The Law of 21, July 2023, the Toolbox Law, brought in several important modernizations to the broader fund framework. One change, very relevant to depositaries, concerns their replacement. The old law had a rigid 2-month notice period.
Which could be tricky in practice.
Could be very tricky. 2023 law removes that rigidity and allows the notice period to be defined contractually in the depositary agreement itself. More flexibility, seemingly. However, and this is a crucial implication, the law now explicitly states that if a replacement depositary isn't appointed by the end of whatever notice period is agreed, the CSSF has the power to actually withdraw the fund's authorization, which triggers its liquidation.
Wow, okay. So potentially high stakes.
Very high stakes. The law also formally wrote down that issuing and redeeming of funds units is prohibited if it doesn't have a depositary, or if its depositary goes into liquidation. So while it looks like more flexibility on the surface, This change actually increases the pressure on fund boards. They need to manage their depository relationships with extreme care. It makes those termination and transition clauses in the agreement more critical than ever. And subtly, it gives the incumbent depositary quite a bit of leverage during any notice period.
Right, the practicalities. Okay, so we've covered the functions, the shifting landscape. Let's get down to the nitty-gritty now. How do you actually establish these vital relationships, from appointing them to negotiating the agreements?
Well, forging these relationships, it always starts with meticulous selection and due diligence. We mentioned CSSF Circular 18/698. Before, for any delegated function, the ISM has that non-delegable duty. They have to conduct and properly document thorough initial due diligence on the proposed service provider. This isn't just a tick box exercise. It means a rigorous assessment. Regulatory status, professional reputation, financial stability, operational capability, tech infrastructure. Does it all match the fund's specific strategy and risks?
And for new regulated funds?
For a new regulated fund like a UCITES or a SIF that's a specialized investment fund, the appointment process is actually baked into the fund's overall authorization by the CSSF. You have to submit draft depository and central administration agreements. The TA function is usually part of central admin to the regulator, typically now via the CSSF's online eDesk portal. And remember, for an entity to even act as a depository for any regulated fund, it needs specific permission from the CSSF first. The absolute cornerstone, legally, is the written agreement, mandated by law.
Okay, the agreement. You said earlier it's like the fund's armor. It's clearly much more than just a standard contract, then.
Oh, absolutely. It's far more. The service agreement is really a detailed blueprint for allocating risk between the fund and the provider. Providers will, of course, present their standard templates, but those should be seen as just the starting point, the opening bid in a negotiation. The goal is to meticulously tailor that document to the fund's unique profile, its asset classes, its distribution model, its risk appetite.
So what are the key clauses to really scrutinize?
Well, first, the scope of services and SLA's service level agreements. You need surgical precision here to avoid disputes later. For a depository, what are the exact procedures for cash monitoring? What are the methodologies for ownership verification for, say, private debt versus real estate? For a transfer agent, what are the concrete turnaround times for processing subscriptions? For handling investor queries, get it in writing.
Okay, scope. What else? Liability must be huge.
Huge. Liability and indemnification is invariably the most intensely negotiated section. It's where the rubber meets the road on risk. For the depository, you have near-strict liability for the loss of financial instruments held in custody, even if lost by a subcustodian. The exceptions like an external event beyond reasonable control have a very high bar. For other losses, like operational errors, liability is typically based on negligence and is usually capped. For the transfer agent, liability is generally based on negligence or sometimes gross negligence if the provider can get it. And it's almost always capped, often at a multiple of the annual fees, for example.
What about information flow, especially with those new rules?
Critical. Information flow and reporting clauses are absolutely crucial now. The agreement must clearly spell out who provides what information, when, and how. For the depository, this underpins their ability to actually do those mandatory ex-ante checks on illiquid asset deals. They need the data. For the transfer agent, clear information flows are essential for effective AML monitoring and, of course, for travel rule compliance.
Okay, scope, liability, information. What else?
Delegation and subdelegation. Especially for the depository, the agreement needs to reflect the strict controls that UCITES V and AIFMD place on delegating the safekeeping function. Then, confidentiality and data protection, obviously vital given all the sensitive investor and portfolio data being handled. And finally, termination clauses. As we discussed with the Toolbox Law, these have gained immense importance. Define the grounds for termination, the notice periods, and crucially, the cooperation needed for a smooth data transfer to a new provider.
So you're at the negotiation table. It really does sound like an art form mastering this.
It truly is. It's a sophisticated art, much more than just legal wordsmithing. It's fundamentally about strategically allocating risk. And it has to be driven by the fund's specific strategy. You see consistent pressure points. The liability cap, that's a classic battleground. Providers want it low, funds want it high, especially reflecting the risk of the mandate. The standard of care is another. Providers push for gross negligence, which is harder to prove. Funds will argue for simple negligence. The scope of the indemnity, what the fund gets reimbursed for, is also key. You want to carve out losses caused by the provider's own failures.
And you mentioned a new battleground emerging.
Yes, absolutely. post that CSSF clarification in 2024 on illiquid assets, the depositary now comes to the table demanding strong contractual rights. They want the right to receive all necessary information before a transaction happens, and, crucially, the explicit right to refuse a payment instruction if they aren't satisfied with the documentation provided ex ante.
But the fund manager wouldn't want them to have a veto, right?
Exactly. So the IFM, the investment fund manager, will push back. They'll seek to qualify that right, maybe limiting it to what's reasonable required under the regulations. They want to avoid giving the depositary an effective veto over investment activity, which could just cause operational gridlock. Successful negotiation here requires really understanding both the legal text and the underlying regulatory pressures, the commercial realities. It's about anticipating future problems, future arguments, and deciding today who bears the cost if they happen.
Right. Okay, let's talk brass tacks then. Costs. What are we looking at, and how long does this all take to set up? From concept to go live.
Okay, costs. The total cost structure has a couple of main parts. Regulatory fees paid directly to the CSSF, and then the commercial fees paid to your service providers. Regulatory fees are set by that Grand Ducal regulation of 23 December 2022. Just as examples, there might be a one-off fee of, say, 15,000 euros for the CSSF to examine a request to acquire a qualifying holding in a financial entity, or maybe 25,000 euros for an on-site inspection. And then there are annual supervision fees for undertakings for collective investment. These are tiered based on net asset value, or NAV. They can rise up to 35,000 euros per year for funds over 700 million euros in NAV.
Okay, those are the regulatory fees. What about the actual service provider fees? Depositary, TA?
Right, the commercial rates. These vary widely, of course. Depositary fees are typically charged as basis points of NAV.
Basis points meaning hundredths of a percent.
Exactly. Hundredths of a percentage point. So 0.0 something percent. And the rate is highly sensitive to the fund's strategy. A complex AIF investing in tricky illiquid assets, that's going to command a significantly higher fee than a plain vanilla liquid UCITS. It just reflects the increased risk, the higher liability, the more intensive work. While it's all confidential negotiation, one example mentioned a potential fee up to 0.09% per annum for certain depositary mandates. Transfer agent fees often have a hybrid structure. Maybe a fixed annual fee per investor account could be anywhere from, say, 15 euros to 40 euros or even more per account. That's often supplemented by per-transaction fees for subscriptions, redemptions, etc. Sometimes you might also see a small basis point fee charged on the fund's NAV by the TA as well.
And what if the asset manager uses its own group companies for these services?
Good point. For vertically integrated asset managers using in-house or affiliated service providers, transfer pricing becomes a critical tax consideration. All transactions between related parties must be demonstrably at arm's length.
Meaning, at a price, an unrelated third party would charge or pay in the open market.
Precisely. Tax authorities look closely at this.
Okay, so beyond just the headline number, what truly drives the value in these pricing models? A higher price isn't always bad, right?
Absolutely not. The art of pricing here is understanding the value drivers.
Yeah.
What are you actually paying for? A higher price may be justified if it buys you lower risk or much greater efficiency. Key value drivers today. Technology and automation is huge. A provider that has invested heavily in sophisticated RegTech platforms.
For things like onboarding, AML, travel rule, those ex-ante checks.
Exactly. If they have systems for seamless investor onboarding, robust AML screening, efficient travel rule compliance, comprehensive ex-ante checks, that capability justifies a premium fee, because it offers the fund greater efficiency, probably better investor experience, and critically, a lower regulatory risk profile. That's valuable.
What else drives value?
Expertise in niche assets. If you have complex illiquid assets, a PDAOFI with proven, deep expertise in that specific asset class offers immense value. They know how to navigate the unique verification challenges. That specialization commands a higher price. Liability assumption is directly priced in. A provider willing to accept a higher contractual liability cap or agree to a more fund-friendly standard of care, like simple negligence, they'll price that risk acceptance into their fee. And while bundling of services, getting depositary, admin, TA, all from one group can offer convenience, you really need to analyze the quality and cost of each individual service within that bundle. Make sure you're not overpaying for mediocrity in one area just to get a good price elsewhere. Benchmarking, really understanding what you're paying for, is essential. Be wary of suspiciously low-ball offers. They might hide service gaps or unacceptable risk allocation later.
That's great advice. And finally, timelines. For any fund manager planning a launch or maybe thinking of changing providers, this is absolutely crucial. What should they realistically expect?
Timelines, yes. They vary significantly depending on the fund type and the situation. For regulated funds, UCITES, SAFs, which need that CSSF authorization, the whole process, including appointing and onboarding the key providers like the Depositary and Administrator TA, typically takes between 2 and 4 months. It's largely dictated by the regulatory approval timeline.
And unregulated funds, RAFs.
Much faster. For unregulated funds, specifically RAFs, reserved alternative investment funds, the process is considerably quicker because they don't need direct CSSF approval before launch. You could potentially establish a RAF with its service providers fully onboarded within about 2 to 6 weeks.
What about changing providers for an existing fund?
That's a more complex project. Changing providers involves migrating significant amounts of data, integrating systems. It typically takes somewhere between 3 and 6 months to manage that transition smoothly. And finally, let's not forget investor onboarding, which is primarily the TA's role. That can range from just a few days to potentially several weeks per investor, depending on their complexity of their jurisdiction, the quality of the documentation, and allows several weeks for getting the initial cohort of investors fully onboarded when a new fund launches.
Right. Okay, so we've dissected all this complexity, the roles, the regulations, the practicalities. After all that, what truly makes Luxembourg uniquely attractive for these critical fund functions? Why here?
Luxembourg's value proposition is genuinely compelling, and it's multifaceted. It's not just one thing. First, it's the deep and specialized ecosystem. You have this unparalleled concentration of expertise depositaries, TAs, administrators, law firms, auditors, consultants, all physically close, working together constantly. This density fosters rapid problem solving, innovation, and really effective collaboration.
And the PDA OFI regime you mentioned.
That's a perfect example of the ecosystem strength. The PDAOAO regime is an ingenious, bespoke solution. It was created specifically to meet the needs of alternative funds investing in non-financial assets. It deepens the specialization here in a way few other jurisdictions can match.
What else?
The prevalence of the registered share transfer agent model. We talked about this, allowing investors to be named directly on the register. It offers transparency, potential cost savings for the end investor, and it's proving highly attractive for global distribution, especially these new digital platforms connecting directly with investors.
And the regulator plays a big role.
Absolutely. It's underpinned by a culture of regulatory leadership and pragmatism. The CSSF is undoubtedly a robust, demanding regulator. But crucially, it's also remarkably accessible, knowledgeable, and deeply engaged with the industry it supervises. They listen, they adapt. The continuous modernization you see, like the 2023 Toolbox Law and the move towards digital interaction, like the CSSF's eDesk portal, it all shows a clear commitment to keeping the jurisdiction competitive and efficient.
And looking forward, technology.
Yes. Finally, Luxembourg is actively embracing digitalization. The jurisdiction is working hard to position itself at the forefront of the next wave of financial innovation. That includes things like the tokenization of fund assets, using blockchain and DLT distributed ledger technology for fund distribution and administration. You see pioneering initiatives like Funds DLT, which uses blockchain to try and streamline fund distribution. Luxembourg isn't just reacting, it's trying to shape the future.
This has been a truly illuminating deep dive, really helpful. As we wrap up, what are the absolute must-knows, the most crucial takeaways for our listener from everything we've discussed today?
Okay, the 3 core takeaways, reinforcing what we said at the start. 1. The era of ambiguous depositary liability. It's over. That CSSF mandate for ex-ante controls on illiquids is real, it's enforced, and it creates a new, much more rigorous operational reality for AIF depositaries. You have to factor that in. 2. The transfer agent's role has been fundamentally reshaped by the travel rule. It's now a dynamic, tech-heavy, per-transaction compliance enforcer, a very different job than it was just a few years ago. And 3, that principle of non-delegable oversight from CSSF Circular 18/698, it remains absolutely central. It places a heavy, unavoidable burden of documented due diligence on every single investment fund manager. You can outsource the function, but never the responsibility for overseeing it properly.
Right. And these 3 developments, when you put them together, they really underscore a clear trend, don't they? An accelerating trend. A flight to quality, a flight to technology, a flight to deep expertise. In this environment, which is only getting more complex, more demanding, the roles of the depositary and the transfer agent are just more critical than ever. They're not just service providers anymore. They truly are, as we said, the indispensable sentinels of the Luxembourg fund industry. So perhaps a final thought for you, our listener. As you navigate your own fund structures or think about your service provider relationships, how will these increasingly complex, increasingly critical roles of the depositary and the transfer agent reshape your strategic decisions, your partnerships in the years ahead? This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Hit that like and subscribe button. It was the deep dive for you today.